Energy analysts are heading for the exits. A wave of equity analysts downgraded dozens of oil industry stocks on Wednesday, a day after crude slipped into a bear market, falling more than 20% from its highest close this year. Analysts took an increasingly pessimistic view of the world's ability to soak up the global oversupply of petroleum. "This is like a falling knife, wouldn't catch it right now." People are already calling this as the worst sentiment they've seen in 20 or 30 years. New York-based investment bank Seaport Global Securities LLC downgraded 51 explorers and oilfield service providers, including Apache Corporation, Continental Resources Incorporated and Devon Energy Corporation, in a note that warned crude could plunge below $30 per barrel next year. Barclays plc and Morgan Stanley, meanwhile, slashed estimates for Schlumberger Limited and the rest of the services sector, citing the potential for as much as a 50% drop in stock values. Big Oil wasn't spared either. Analysts at Macquarie Capital Limited in London cut ratings for Royal Dutch Shell plc, Chevron Corporation, Eni Spa and BP plc, warning the companies may require further, painful cost reductions if prices keep slipping. Capital One Securities analysts downgraded Hess Corporation and 3 other E&P companies. A decline in gasoline inventories reported Wednesday by the U.S. Energy Information Administration wasn't enough to brighten the outlook, as West Texas Intermediate oil futures continued to slide. They rebounded slightly on Thursday, climbing 1.4% to $43.14 as of 11:10 a.m. in New York. Brent crude, the global benchmark, rose 1.8% to $45.64 after finishing the previous day at its lowest level since November. Shares on the S&P 500 Energy Index gained 0.5%. The index was still off 14% for the year. Analysts believe crude prices need to fall to $40/bbl to force production cuts that would stabilize supply and demand. If not, the market faces as much as a 2.2 million barrel per day surplus next year that will only get worse through 2020. Something is to give to keep the market in balance. Per barrel prices may fall back into the $20s early next year and average $35 per barrel in the first half of 2018, prompting massive cuts in U.S. drilling rigs, they said. In New York, analysts downgraded 9 service providers including Nabors Industries Limited, given the increasing odds of a bear case scenario. The new consensus is that global oil markets could swing into surplus in 2018, and the burden of proof that this will not happen lies with the bulls.